Seth, thank you so much for coming back into the office. I know that you're very interested in taking, the next steps. And I really want to just talk to you about, the things that are important to you, which we have already discussed, like life insurance, why it's important, why you need it for you and your family. Are we doing this? Sorry. Why is it that you need the life insurance now that you have a son and things of that nature? So let's go ahead and get started with life insurance. And I just really wanted to explain to you, because you do have a risky job and you are looking to buy your first home with your significant other and your child, we want to make sure that we're protecting that. And I want you to really understand that life insurance has evolved and it's changed. Life insurance now has living benefits. And what does that mean? If you have a chronic, a critical, or terminal illness, you can access that policy while you're alive. And that's a huge benefit. In fact, I really want to share with you that my son is a recipient of that type of policy. Life was perfect until it wasn't. And I got to tell you, when things happen, you never get a warning. And from one day to the next, my son is perfectly healthy, and now he's been diagnosed with cancer. Thank God that he had this policy, and he got a check for $372,000, which I will tell you helped him pay his mortgage. He has 2 kids. His wife, obviously they have cars, and it just really helped him get through a very difficult time in his life. And he was able to focus on his care. He didn't work for 22 months. So I want you to think about that. If something happened to you and you weren't working for the next 22 months, what would happen to your household? And so that's why I feel so strongly about that. That's the foundation of the plan that we're going to put together for you today.
So you're telling me that I can buy for X amount of dollars a month a life insurance that will actually pay me before I die. I don't have to die to get life insurance.
Absolutely.
Is there like some special stipulations or some hoops I got to jump through, or like is it fairly laid out? Like how do I know if I'm going to get a check because of whatever? Like how does that work?
Yeah. So it's pretty basic and very clear in the application. If you have a chronic illness, is something that falls under the lines of where you cannot do 2 of the 6 activities of daily living. The other one is a critical illness, like a cancer diagnosis. Maybe you suffered a heart attack or a stroke, things of that are critical. And the last one would be a terminal case. If the doctor said you had 12 months or less to live, you could access up to 90% of that policy face value and maybe make memories with your family. So many people do that kind of stuff because nobody has like 90% of 500,000 laying around. So at a minimum, a $500,000 policy, which is what my son had. And, obviously we're going to take a look at your financial needs analysis and see how much coverage you do need. I'm just giving you that as an example. Nobody has that kind of money laying around. That's why you want to have that policy, because what you're doing, Seth, is you're transferring the risk of the what ifs of life to the insurance carrier instead of to your pocket. I think should that make a little bit of sense?
It does. And then like, what if something just like happens to me and I'm like disabled or something? Like maybe I'm not like, I don't get cancer and I'm not terminal, I'm not going to die tomorrow, but I still can't work. But I can wipe my butt and I can get out of bed and I can do my daily activities, so I'm not necessarily chronic. But is there something that I could have or something I can do to protect myself and the family if I was just to become disabled with this job that I have?
Absolutely. With that specific policy, the living benefits policy, we can add a rider for disability.
Okay.
Absolutely. And if you had a disability, you could get a monthly income from that insurance policy.
Yeah, that sounds more interesting. Mm-hmm. So I can get life insurance if I don't die.
You get life insurance if you don't die. Those are new. Those are new features and benefits. And the reality is, I'm going to be honest with you, like 79% of those types of policies get access, right? Because we're finding that people are having chronic, critical, and disease, and so that really is such a protection to what you're putting together, the foundation for your family, the home that you're about to buy, your child.
Well, I got to say, I mean, like, you're a mom, so you're gonna be all Miss Motherly and everything. You're worried about what happens to me. I'm a little wilder and crazier. So I think more about taxes. Like, you're the financial strategist. Like, tell me about something cool about taxes, because I'm tired of paying taxes. I'm working for myself. I finally started making money, and now it seems like I give as much to Uncle Sam as I do anyone else. So, like, what can I do for taxes? Because, God.
I know, I know. I got to tell you, that's a huge pain point for people because everyone is saving in traditional buckets, right? So, the 401k, 403b, and our firm does all of it, right? Because we have the gamut of everything on the financial industry. The reality is, though, we're finding that everyone has been saving in these taxable buckets, and now you have either a pension, you have a 401k, Social Security can be taxed. And so people now are in retirement and they're paying a lot of money in taxes. So what we're doing with individuals such as yourself, right? You are in a perfect age to start what's called an index universal life policy. Basically, it's been around since the early 1900s. It just hasn't been around to everyday Americans. Wealthy people are very well exposed to it. Our firm has spent the last 25 years really knocking on doors and getting in front of business owners like yourself and helping them understand this strategy. You're going to put after tax dollars into this bucket of money. The umbrella is the life insurance. That's what protects the money, allows you to grow it tax free. And when you go into retirement, Seth, you're going to pull the money out tax free.
So is that the thing I keep hearing on TikTok and Instagram about borrowing my own money or infinite banking, or I don't know. What is all that?
It is. It is. So basically, it's an index universal life policy. There's a lot of bells and whistles. It's actually known in the financial industry as a Swiss Army knife because of all the features and benefits. And so, we'll sit down and look at exactly what it is that you need. All the insurance companies have different features and benefits, but because they have like living benefits, you can borrow money from it. You can pay yourself back. It has long-term care if you'd like to put a long-term care. You can put disability riders on it. It's just a Swiss Army knife. You can borrow money. Seth, in the future, you put this into place and you start building cash value and you need to buy something for your shop. Seth, take the money from this policy. The money's still participating in the market. You're still making money, and yet you made a purchase for your business, and then you can pay yourself back.
Yeah, so that's something I heard. One of my friends was telling me that he borrowed money from the policy, used it for something in his business, and then put the money back later. In the meantime, somehow he was still making interest with the money. And I'm like, well, if you took the money out, how the hell are you collecting interest on the money if you took it out? I don't really understand. Like, how's that possible?
Yeah. So there's a lot of insurance companies, and those are called participating loans. What does it mean? It's still participating in the indice while you've borrowed the money. The beautiful thing about borrowing money from your own cash value is that you're only paying simple interest. Seth, I can't tell you, when you borrow money from the bank, you're paying compound interest, and that's devastating to a lot of people, especially in the times that we're living in. You as a business owner and you need to take out more money and you go to the bank's charging you 13, 14, 18% compound interest. These loans are running from 3 to 5% simple interest. You can borrow the money from yourself, from the cash value that you've built into your policy.
Okay. And like, how much does this IUL grow? Like, is it, I don't know. I've had a whole life policy before. It wasn't very impressive. So like, how does it grow? Like, how does it go up and down? And how do I know what it's worth?
So what happens with the index universal life policies, they all have a floor. So what does that mean? Even if the market goes down into the negatives, and we've seen a lot of fluctuation, your policy doesn't lose any. There is a floor. It's 0 or 0.75, depending on the carrier that we go with. They're typically earning anywhere between 6 to 9%. But I got to tell you, Seth, I mean, Transamerica has an incredible product, and it's been returning 11, 12%. And our clients are super excited and happy about this type of return in an environment where there's no risk.
So the money will never go down. The market goes down, my money doesn't go down. I could check it and it doesn't go down.
Exactly. It's called a floor. So that's really an index strategy.
Yeah.
There's several financial products in the industry that have that type of growth on an index, and the Index Universal Life is one of those financial products.
Okay. All right. So what other cool tricks you got up your bag of sleeve with the financial strategies? What else you got for me?
So because you are a business owner, right, and we're going to look at how your you pay taxes and how you're set up and your corporation and things of that nature, there is a possibility that you could actually do an executive bonus plan. Your business can pay for your retirement. And so it would be a write-off to your business. And so that's something that, we'll look at how you file your taxes for your business and see if that's applicable to you. But that's another great strategy. I know that we've already sat down and put the $1 million baby together for your son. And you guys are doing an incredible contribution on a monthly basis. It's going to be the best thing that you've ever done for your kid. I promise you that. So I'm excited that you already have that in place. But in all reality, I think that what we really want to look at today is making sure that you and Tatiana are both, properly insured, that you have the policies with living benefits, especially because you're about to buy your home and you're closing on your home. And we want to make sure that, yeah, I am a mom and I'm a grandmother, and I want to make sure that your son's protected.
Okay, so I have one more for you. Let's see what you know about this. In Miami, they have a thing called trust fund babies. And there's not a whole lot of those in North Carolina where I'm from because there's not a lot of trust funds going on. But I don't think I'm ever going to be a trust fund baby. But what is a trust? Like, why do people have trust? And like, I know like they can get cut off from their trust and their money can come or not. And someone is in charge of it. Like, I mean, what is the trust thing? Like, why do these rich people have trust and why do their kids have trust? Like, what is that?
So let's talk about your son's $1 million baby, right? And we've looked at that. What does $1 million baby stand for? Something very powerful happens, which is the rule of 72, which is compound interest. And when you have time, your son will be $1 million like asset. He will have at least $1 million. And if I'm not mistaken, I'm just going off of what I remember. I think it was closer to near 2 million based off of the contributions that you guys are doing. You could actually put that into a trust, and the trust would pay him, right, on a monthly or on an annual basis, which is where we get this quote unquote trust fund baby.
Oh, so my son's going to be a trust fund baby.
Yes, he can be if you set up that trust.
He's likely to get cut off. All right. Well, that sounds great. I appreciate the help and looking out. I'm looking forward to.
Absolutely. I can't wait to sit back down with your significant other and put these policies in place for you and her.
Is there anything else that you do that you offer to clients that maybe is not necessarily up my alley that's important that, may spark interest in someone? You have any little cool things you want to drop? Is there any little things that you offer or do that people may not have heard about as a financial strategist?
Yeah, I think because you're around so many individuals in your business, if you ever hear people looking for, one of the things that we're finding right now is a lot of people are worried about running out of money in retirement, not having enough money. And there's financial products like in the annuity space that guarantee income for life. And so that's something that we're working with a lot of clients right now. I think it's really the biggest concern with the aging population. So
okay,
I know
hold
that
on.
you have.
Before you get off on the story about aging population, back up to where you said guaranteed income, because like that sounds good to me. Like, how do I get a guaranteed income or someone else get guaranteed income? Because that sounds like nothing I've ever heard of before.
Right. So you can either roll over a 401k. In your case, it would be cash, right? Because since you are independent.
So I'm going to sell some motorcycles.
Right. And then you can take
some money to work.
And then you can take a lump sum of money, put it into an annuity. You're still young, right? So we want to grow it. So there's accumulation and growth solutions for somebody of your age. But once you get closer to retirement, then we would roll those funds now that they've grown, and we put them into what's called a guaranteed income for life. And it's an insurance policy on your money. It's an annuity, and it will guarantee income for the rest of your natural life. And the beautiful thing is we can make it joint with you and Tatiana, and both lives are covered. So when you think about Social Security and people that you know that might already have social, like your grandmother, your mom, and things like that, right? That's a reliable source of income that people are relying on every single month, Social Security. The same thing happens if you have a pension. It's a reliable source of income. Well, this allows individuals that do not have a pension to create, quote unquote, their own personal pension through the purchase of an annuity.
Okay. Well, that sounds like a lot of fun. I'm gonna have to get some money to put into an annuity apparently.
Absolutely. I
All
love
right.
them. They're
Very
amazing.
cool. All right, so I'll just only have one question to that one because, like, coming from North Carolina and some of my friends, we'll call them old school, and they're buying gold and silver and all that and hard assets. Why not buy a rental house with an annuity money? Like, instead of getting an annuity and getting an income, why not buy a rental house and collect income on that for the rest of your life? Like, I mean, if you say, let's just say the ROI on the rental house is 7 or 8% and the return on the annuity is 7 or 8%, why would I go put this in some piece of paper and not just buy a real asset so that I have this house with this income? Like, what's the difference in the two? If you call it the income's the same and the return's the same, what's the difference?
Yeah.
Like, why not do that? Why not just buy a house?
In our reality, I love real estate, right? So multiple homes. I love also doing that, right? However, I also like the stability of the guarantees over here. There's so much instability in real estate, and it really depends on the person and what they like to do. I'll give you an example. Like, I have a client right now that has properties in New York. She's got 2 homes in New York, and her husband passed away. She's been dealing with this. She's 65, and she's like overwhelmed. It's not something that she knows how to manage. It's not something that she can, and it's 2 properties that are paid for. It's income. People aren't paying. People are, the apartments aren't filled. And so for this particular client, she doesn't want the headache of that whole rental situation of having to be a landlord. She says that's not her forte. So she's going to be selling that asset and putting it into annuity, because what she's looking for is a reliable source of income. And unfortunately, in her situation, right, she's had to pay to evict people, and that's an expense. I mean, so she's had a lot of issues like that. I like all of it. I like doing all of it, but I also like the stability, right, that the annuity provides. And it just depends on someone's, I don't know, let's just say if they're more able to tolerate risk, not risk, that type of stuff. So it depends on, someone's age, I believe. My son has rental properties. He's got 3. I think it's awesome, right? But he also has an annuity. This is the guarantee on this side, right? From an old 401k.
So maybe it doesn't have to be one or the other, but some kind of blend of the two, where one is a little more stable and one is a little potentially more profitable, depending on the market. But okay.
Yeah. I mean, I think I love all of it. I do. I really love all of it. I just like to show the pros and cons, right? Real estate is going to increase in value, so that's a plus. If you like being a landlord, that might be an opportunity. But at the end of the day, what people that are going into retirement are looking for is a reliable source of income. And to be honest with you, they want to move it out of the stock market because they want to live off of this money. They do not want to lose any of it. And so that's what the annuity does. It gives them that protection because it also has a floor. Remember that we talked about that on the Index Universal Life. It has a floor, so you're never going to lose money. And once you complete the application, it's a contractual agreement with the insurance company.
So the annuity, it grows with the stock market, like you said, the IUL does. Like, you put money in and then it grows.
It does grow. It grows.
Like, how does that work?
So I want to kind of explain to you, when we say index, the Index Universal Life, or an annuity in an indexed financial strategy, that basically means it's a mirror to the stock market. So when you're in there, you're mirroring the market, but you're not in the market. So that's what an index is. And so basically that's why the insurance companies allow a floor. They also have caps. And so you can also buy additional riders so that you don't have these caps. I mean, there's just so many ways to put them together. And so we sit with our clients and we look at what it is that they're looking to accomplish. And then we go out and find the best product. One of the things, Seth, that I really want to let you know is I have access to over 100 carriers, the best of the best on the platform. So I'm not just going to go wiggle myself into one thing for you and all my other clients. Whatever it is exactly as we continue our conversation, we're going to go out and find the best product for you and your wife.
Sure. The only other thing I would say is my grandma told me like she had an annuity one time and like all her money was just like locked away or something, like she couldn't get to it. She felt like it was like you kind of like tuck away your money forever or something. Like what's that about? Like does your money like disappear for a certain amount of time and you can't touch it, or like what's up with that?
Yeah, I want to kind of explain that to you because a lot of people, like any financial product, all products have pros and cons. So you are giving up liquidity, but it's kind of the same thing as a CD, right? So when you put money into a CD for 5 years, you can't touch the money. So in that same space, whether we do a 7 or 10-year annuity, you are committing those funds to the insurance company, but you can borrow money from there, which you can't even do with a CD. So those are, maybe some people might consider that like a con. I really feel like that's like a safety net, a safety lock for people, because I'm just letting you know, most people, if you don't put it into a financial product and you let them siphon it out to you, most people will spend all their money before their life is over.
But if you want the money, you can get it, right?
Absolutely.
Like, it's not like you
Absolutely.
can't have your money, right? And so like it still grows and it's there, and
Yep.
you just you can't go in and out with the money all the time. It has to stay there.
Right.
So if we were going to do this, it would need to be money that we want to park, like literally park it
Exactly.
and then use it for later.
Exactly. 100%.
Is there like I mean, maybe I'm not of the right age, but is there like a age or a type or a situation when someone should have an IUL versus an annuity? Like how do you said they both grow similar, they both track the market, they both build up, but like I can understand why I could use an IUL because whether I own a business or I just make money, like tucking that money away and then using it later without paying taxes on it sounds amazing. But like, do I wait till I'm a certain age for this thing over here, or do I do it now? Like, or I don't even know if I have any money to give them right now. So like, how do you decide to get an annuity, like, or to get an income for life? What do you need to get an income for life? Like,
Right.
how's that
So
work?
let me kind of explain to you. Annuities, you can have them starting from the age of 30. And typically the clients that I'm working with, they're rolling over old 401k funds. If you don't have a 401k, I'm going to highly recommend the Index Universal Life, because you want to put it into a financial product that you can access it tax-free.
Okay.
Does that make sense?
Yes.
We can, typically, most 401ks are tax deferred. You're just paying taxes in the future, unless there's a component of a Roth. So I want to touch on that real quick, because the Roth is the only other product other than the IUL that you can grow money tax-free. But there's income restrictions for single people and for couples. So I think that you and Tatiana don't qualify for a Roth. And so the next thing, tax-free, is the IUL.
Okay, so you saying that, and when you say like qualify and things like that, so I have another friend of mine that is a hacker, and he got moved to Silicon Valley, and he gets paid an insane amount of money, and he can't put all of the money in his 401k or whatever retirement thing he has. Like I think they say he's capped. So like, what do you do if you have the problem of all of a sudden I start doing so many motorcycle suspensions that I have more money than I can put in a SEP? Is that you put it in the IUL instead, or like is that something that I can do? Like if you do max out your 401k, now what is that what the IUL does? Is like is another way to like, how do you do that?
And I really just want to kind of explain it to you like in buckets, right? Like in buckets. And so when we're working, there's a bucket for Social Security. There's some funds that are being retained, whether you work or whether you are 1099, you pay towards your Medicare and Social Security. Then you have this other bucket. Yes, 100%. You can do a SEP, a solo 401k, an IRA, anything like that. And if you're maxed out your contributions, because that's another thing. The government limits you on the contribution. You can open up an IUL, and now you have a tax-free bucket.
Okay, and then as far as restrictions goes, because you know how much I love the government, is there like these rules about ages with these things? Because like I know that on any kind of retirement, there's like this 59 thing, then there's a 70. I don't know all the rules, but like, do these have the same rules?
So that's a great question. So all of the traditional 401k, 403b, retirement plans, all of them, they have what's called the 59 and a half rule, which means you shouldn't touch the money before you're 59 and a half because you will have a 10% penalty. Not to mention that you're being penalized on your own money. Once you take the money out, you're paying taxes. So you're getting hit twice. So if you start something, young people typically that work are going to start a 401k because we're trying to get in front of as many people as we can, right? So I know that you have a lot of people in your business that if we can teach them another way, so that's the 59, we want to help them understand the IUL. Why? The Index Universal Life doesn't have any of those restrictions, right? You can borrow money from them. There is no age gap on the traditional IRAs, 401ks, 403bs, etc. There's even a required minimum distribution. Even if you don't need the money, you're going to have to take it, or the government penalizes you 50%
In a 401k.
in a 401k.
Okay.
And those traditional models. But in the Index Universal, Seth, none of those rules apply. None of them.
Okay.
You can borrow money, take money, pay it back. Not a problem.
Okay. Well, that sounds a lot of fun.
Yeah.
Can you just explain to me how any of that becomes tax-free? Like I got what you said. I think you said borrow it, but like, how do I get the money out of the IUL and not pay taxes like I do on when I take money on it? Say I am 50, I'm of age to 401k, right? I'm paying taxes clearly. But like if I get an IUL, how am I not paying taxes all of a sudden? If I'm going to do the same thing, I'm going to take money out. I don't pay taxes.
Right. So the IUL, the umbrella of the IUL is an Index Universal Life. Not to bore you, but there's an IRS code that allows you to grow the money inside of that financial product tax-free. So when you think about how is it tax-free to you, if you take a loan from the bank, are you declaring that on your taxes when you borrow money from the bank?
No.
No.
Because I owe it back.
Right, because you have to pay it back. The same thing with the IUL. You're just borrowing the money from your own cash value, so there are no taxes. You don't have to declare them as
So it's
income.
not technically income.
Exactly.
I understand. Okay. What about the annuity? If I get that and I get income from that, you said guaranteed income for life. Is that tax-free?
So it depends on how that bucket is initially started. So we can do a Roth annuity or a qualified annuity. A qualified annuity typically is coming already from an old 401k, an IRA rollover. Those qualifications follow that client because they don't want to pay the taxes. So if you have a 401k with $400,000 and now you want to roll it into an income solution annuity, you roll it over into the same qualified status so that you're not going to pay any taxes. Once you start distribution and retirement, it will be a taxable.
Okay.
But because you already started it as taxable.
Sure. Can I roll, let me be careful. Can I roll my 401 for like Tatiana, right? She has a 401k with a large company. Can she roll that out when she's time to? Can she roll that out and pay taxes on it right then and just be done with it so that the money comes out later? Like, I guess maybe like Roth or something. Can she do, when she does the conversion, can she get an annuity that she's already paid all the taxes on, or it doesn't work like that? Qualified stays qualified.
I gotta tell you that we have a carrier on our platform that's just absolutely amazing. Just to keep it simple, right? You would move her 401k, which is qualified, into a qualified annuity, and inside of it, once the funds are there, you can convert $3,000 at a time so that you're paying taxes, right? Because it's a taxable bucket, but you can convert it into a Roth on an annual basis, $3,000 on an annual basis, which is not going to really break the bank, right? It's going to add $3,000 to your income because you do have to pay taxes. But once it's in there, you can convert it to a Roth.
Okay. I'm just looking to minimize
Yeah.
my taxes, you know.
I
like,
know, and
you
it's
know,
and it's a big deal because I'm just letting you know. I'm sitting week after week after week with a lot of clients, and their pain point today is taxes. And so we're trying to help people understand, create a tax-free bucket with that Index Universal Life. First of all, Seth, your family's going to be protected your entire life, right? I always tell people, I wish my parents knew about this stuff because when my dad passed away, we would have had an inheritance. If when my mom passes away, we would, it's what I do for my own children, right? I want to be able to leave them an inheritance. But at the end of the day, you're covered whether you die too soon, you get sick in the middle, or you live through retirement. You can just take it out as retirement income.
okay. That sounds like a lot of fun. Well, I guess the only other question I had was looking at this notes right here. We talked about the IUL on my son, and we keep talking about taxes. So, like, is there going to be like a bunch of taxes on him if he uses that money, right? Because we were thinking we did the $1 million baby because, I mean, he has a 529. But what if he doesn't want to go to college and he wants to start a business? I can relate. So,
Yeah.
you know, whatever he wants to do, maybe he wants to elope, whatever. Okay, provided that, you know, all that's situated, like when that money comes out of the IUL, because you said it's going to build cash value, and maybe like by the time he's 50, 60 year old, he has over $1 million, like what does he do with it? Well, you know, does he borrow that money or does he take that money out? Like what happens with that money? Like how does he get access to the money, or like when does he have access to the money? Like what's up with that? Like what's the deal with the $1 million baby when it comes to getting the money back? Like clearly I'm going to pay X amount of dollars for the rest of my life. That's part of having a kid. But when it's time for it to be his, which is the entire point, like what does that look like?
Right.
How does that work?
So right now, because he is a minor, right, you are the owner of the policy. You and your wife are the owners of the policy.
So it's still my money.
It's still your money.
Okay, all right, all right.
So it's still your money. But at some point, you do want to make him responsible. Maybe, I don't know, everybody's different. Like, you know, like I have this conversation with my own children about when are they going to, you know, give their IULs, their $1 million baby IULs to their kids, to my grandchildren. And, you know, it just depends. It depends. We want to see how financially savvy they are. Like I have my older grandkids are super sticklers for money. They like to save. They're not spenders. So that changes the ball game, right? But if I have a child that just misspends money, then I might hold that, you know, policy longer. But let's just say your son's 30 and he's going to get married. You want to gift him this policy. You make him now the owner and he's the contributor to it. He can touch the money whenever he wants, but we want to teach him the value, right? Because at the end of the day, if he goes in there and just pulls all that money out, he could just destroy that policy.
Okay. And if he wants to be a wild child and pull $500,000 out on his 30th birthday and go to Miami, is he going to have a tax bill on this money? No. Like, because that's the other thing is like, you know, you give him a bunch of money and then he doesn't know what to do with it in the first place. And then he doesn't pay the taxes. like what's that look like? Because again, I'm worried about that tax thing. How does that look? Is it tax-free money because we already paid taxes when we put it in there?
Exactly.
Like but it grows. So still that whole thing where
I want you to write this down real quick in your notes, but there's an IRS code called 7702, and that's the IRS code that allows you to grow the money inside of the life insurance policy tax-free. Whether he touches the money, whether he passes away, whether he uses it as income.
Okay.
It's all tax-free.
Got it. One more. When he gets married to someone that we don't approve of potentially, and those two don't get along, is that like if he's the owner of the policy at that point, right? We gift them or whatever you said thing. What happens? Is that like does he have to split that with her? Like can someone anchor baby him or marry him and then turn around and take half of this money that we just built up for him? Because do they get access to that money? Is that part of like his money or how does that work?
Right. So here's the beautiful thing about the Index Universal Life, right? There's a lot of restrictions, right? No creditors, predators, divorce, nothing like that can break into the barrier of what the IUL is. However, if he had a 401k, he has to split it with his wife, but because it's life insurance, he doesn't have to do that.
Okay, so like
it's creditor protected. We say creditor, predator, divorce. It's liens anything like that. So it's great for business owners like yourself, because I know that you're looking at one for yourself, to have them in place because nobody can sue you and touch those assets that are protected by that IRS code.
Okay, so if more or less, if he gets the policy rolled into his name and it becomes his IUL, then we're right back to that whole borrow from it and everything that we were talking about with me.
Yes.
He has all those features, but his mother and I have been placing all this money in there for so many years. By the time he gets there, he's already got a real cash value that he could do something with, but with all the benefits of everything that I've had, that I get now.
That's the beautiful thing of the gift that you're giving your son by having that IUL for him.
Okay, and all of that will bypass paying taxes on it in the meantime.
Exactly.
So that's
because you're paying taxes on the money now, right? It's after tax dollars.
Yeah, I mean, when we had him, we were like, well, what do? We set up a child savings account and we set up a 529 account and we were looking at all this stuff and we're like, well, there's as many rules and restrictions of what you can't do as what you can do.
I know.
And then someone said $1 million baby, and I was like, then I heard someone about trust fund baby, and I was like, okay, I need to figure out what these two things are because there's plenty of that in Miami.
Of course there is.
But I need to know how to do that.
For your own kids.
So this sounds like a good way to get that going. Like if you're going to put money towards this future, then, no one can get a hold of it. No one could take it from him, and he doesn't have to pay taxes on it. I mean, I don't know there's not very many other ways I can think of to give him this money and be able to do that.
Nope.
Not that
the financial industry might seem convoluted, and there's a lot of things out there, but when you peel back the onion and stay with the core financial concepts, it's pretty easy to understand.
Okay. And then this is just a long one, but can you use any of these financial strategies or policies as collateral against a loan or something in the future? Can you do that? Like, how does that work?
Absolutely. So what happens is, if you're going to take out like an SBA loan and the SBA loan is asking for you to collateralize that loan, there's a rights of assignments that are done.
Okay.
Right. There's a form that's specifically for using your life insurance as collateral for your loan.
Perfect. Okay. So that's something, even like if I had an IUL and 10 years, 20 years later, we want to buy an income or an income producing asset, a rental property or something, we could use that as collateral.
You can. In
getting that other property. If I didn't have enough built up in there to just buy it, I could go get a loan, but use to back it up.
Absolutely.
I wouldn't need as much. I could leverage the IUL to back up a bigger loan to get something else. So I could still be making money on the IUL and get the rental property at the same time. So it could kind of be doubling up a little bit. Absolutely.
It's like double dipping, right? So when you are going to collateralize a loan, they're looking for life insurance. God forbid something happens to you, they want to make sure that the loan's going to get paid for. So that's what that's about. But the beautiful thing about what you just said is, yes, once you build that cash value in that IUL and you decide that you want to take out cash and buy an income producing asset, by the way, they're both producing, right? Because this is called a participating loan that allows you to keep growing the money, like if it was still in there, but you just bought this other asset.
So even if I didn't have enough money to straight up buy the house and I got a mortgage, I could take down payment money out of the IUL to get the down payment on the mortgage.
100%.
And then I'd still collect an interest on the money that I used for the down payment, and I'm collecting rent on the money that I put in the mortgage on the rental house.
Absolutely.
So I'm making money twice on the same amount of money.
You are. You will be paying 3 to 5% for that option, because to keep it in as a participating, but you're making more than that on the rate of return. So you're always
you said those things are 7 to 11, and if I'm paying 3 to 5, I'm still on the upside.
And by the way,
and it's still over here too.
Yeah. By the way, that's simple interest, and you're earning compound interest. So that's the big difference. People really need to understand simple interest is a lot less than compound interest.
Well, to keep it simple is that if I borrow $50,000 on a down payment, I owe $50,000 plus 5%, period, regardless of how long it takes me to pay it back.
On an annual basis, while you keep the loan out there.
Okay,
right?
So it'll be 5% per year, simple interest.
Simple interest.
But I'm getting compound interest on the whole balance of the cash value at 7 to 11%, which is larger than that anyway.
Exactly.
So I'm more than making it up.
Like if the $50,000 was still in your investment.
Yeah. And the rest of the money that's still there.
Exactly.
Okay. All right. Well, I think I asked you enough questions about your financial strategies for today.
I appreciate you coming in. I really do. I think that we're going to be putting a really solid plan together for you and your wife. And I'm excited for the closing of your home that's coming up. I think that's going to be awesome. And so,
All right, we'll see how it goes.
absolutely.
Fingers crossed. Thank you for having me. I appreciate
You're
it very
welcome.
much.